Now, lately, what I have been seeing is a lot of companies are putting forward safes for multi-million-dollar fundraisings. Funders prefer it because obviously the perception is that safes are founder-friendly and they are easier to negotiate. I don't personally like safes because they avoid very important investor rights for the future. Many companies who come to us with safes do not necessarily understand that. If you are raising on a safe, I don't know, $500,000 round, then half a year later you go out and raise a $2 million seed round. Most likely by now it's convertible that. The investors who are coming in potentially on the second round of financing will not agree for the safe investors to have better investor rights if they put in less money. So eventually you will have to go back in some occasions to your investors who put in their money under the safes and make them agree to the terms of the convertible note that came later, which is time and money and negotiations.
Welcome to the Invisible Ink podcast. I'm your host, Shubha Chakravarti, Chief Financial Storyteller at Achieve. Our guest for today is Eva Doss. Eva is President and CEO of The Launch Place, which is a venture development organization in Danville, Virginia, and the Research Triangle Park in North Carolina. She has over 25 years of experience in business consulting and business development, as well as early-stage fund investing in the US and in Europe. She's worked with Booz Allen, RTI International, and USAID in Washington, D.C., and is also a member of the Angel Capital Association's board of directors. She serves on several portfolio company boards in North Carolina and Virginia. Now, here's Eva. So, Eva, welcome to Invisible Ink. We're so happy to have you here today.
Thank you so much, Shubha, for inviting me. I'm happy to be here.
So we have a bunch of exciting topics to talk about, but before we jump into it, just to get us started, can you just tell us how you work with founders today and what do you do with the Launch Place?
Yeah, so I'm the president and CEO of The Launch Place. We are a venture development organization. We invest in early stage startups, both from our pre-seed funds and seed funds. To this day, we have raised $25 million, and we have been investing from the fund since 2012. But in addition to providing investments to early stage startups through our pre-seed and seed funding, we also have a not-for-profit organization that's the umbrella of The Launch Place. And through that not-for-profit organization, we provide additional educational mentoring, coaching services and technical assistance services to our portfolio companies and other startups who are interested in getting educated about angel investing or even potentially scaling up their business. So we try to provide as many services, wraparound services to our portfolio companies and early stage startups in our region as possible. In addition to being the president and CEO of The Launch Place, I also serve as the board of directors member at the Angel Capital Association.
Great. And how many companies have you invested in so far through the Launch Place?
So far in our portfolio, we have 27 active portfolio companies, and currently we have 2 in due diligence. So hopefully within the next couple of weeks, we can go all the way up to 30 portfolio companies. And we exited 6, and 2 more are currently under negotiations for potential exit.
I'll keep my fingers crossed for all of those to come through in your favor. That's awesome. And do you have a sector preference or any kind of investment thesis? What's your thesis?
So we like to say that we are industry agnostic, but because of our close proximity to the Research Triangle Park in North Carolina, we have an office there and also in Danville, Virginia. We do end up investing in quite a lot of medical device, health tech, and also SaaS enterprise software companies. When it comes to health tech, we are really focused on either remote healthcare companies or medical devices that do not need more than just a 510K FDA approval. But again, if it's a good business plan, if it's a good business model, we will take a look and invite the startup founder to pitch. But those are the focus areas that just naturally ended up being in our portfolio.
And just for you personally, what's the thing that keeps you excited the most about this work?
Well, at the beginning, it was just getting the word out about The Launch Place and seeing all the new exciting ideas that came along. We have been doing this for 13 years. I personally started the organization with a group of individuals almost 20 years ago as a business consulting entity. And we started investing in 2012. So the last 13 years, was really exciting seeing new ideas. But lately, what I'm really focused on is managing our portfolio companies and helping them to get to exit, because some of them have been in our portfolio through Fund 1, Fund 2, and some of them have been with us and we have been investing in them for 7 years, 8 years. So it's time for us to realize an exit. And that's my focus right now.
For the bird to fly out of the nest, so to speak.
Yes. Yes.
Good luck with that. Okay, so I want to start off, since you're talking about exit, I want to start off with cap tables. It's very relevant. So there's a lot of mystique around this cap table. Just for first-time founders who may not have much familiarity with this, can you just demystify briefly what is this cap table and why is it important from day one?
Absolutely. A cap table, or the longer version is the capitalization table, document that outlines a company's ownership structure, detailing who owns what percentage of the company's share, including different types of securities like common stock, preferred stock, options, and warrants, essentially providing a snapshot of the equity distribution among all shareholders and investors at a given time. It is really important to start the cap table, to build a cap table from day one, even if you are just raising money from your friends, family, and fools, the 3 Fs as we call them. Even in that case, it's very important to have at least at the minimum started an Excel spreadsheet to record all these investments and the ownership of the investments, because if you don't start recording your capitalization table from investor number 1, you may end up having major difficulties in the future as you have additional fundraising rounds and more investors become shareholders in your company.
Is there an example or a story that comes to mind of somebody who wasn't careful with it and it came back to bite them?
Yes, well, there are multiple horror stories. I try to be as kind as I can be, but one that comes to my mind was, for example, in the capitalization table, as you start hiring employees and scale up, some of the senior level employees might require employee stock option, ESOPs, and it's extremely important to record them as you hire these employees. The cap table needs to be updated on a regular basis. So when you hire these employees, you do have a very clear understanding what was promised to them, and they also understand what the company has committed to provide to them, even if the employee decides to leave after the vesting period. And it has happened in the past that not everything worked out well between senior level managers of the startup. And unfortunately, one of them had to leave, not in the most friendliest terms. And unfortunately, his ESOPs, stock options, were not recorded in the cap table at the time of hire. And the employee who left the company had to seek legal action against the startup because the startup simply couldn't find the recorded ESOP shares. Ultimately, they settled, I think, out of court and didn't end up being a big lawsuit, but it could have been. And it was just a simple oversight by the CEO or CFO of the company not recording the issuance of employee stock options at the time when they were issued.
It's a good telling example. Now, clearly a big role of a cap table is to figure out who owns what and how much and all of that. But just outside of listing, hey, here are all the people who own stock or could potentially own stock in this company, is it useful? Is it a strategic tool, or does it have other uses that a founder should be aware of?
Absolutely, because the cap table will ultimately be an extremely important tool for you to understand the basic information that you need to know before you even start a second fundraising. It keeps help. It really keeps track of the ownership structure, which is essential for making informed decisions about financing or investments. For example, if the startup is looking to raise another round of financing, which most likely they will need to know how much of the company is already owned by existing shareholders. Using the cap table can be beneficial for efficient business management. You always want to know an accurate understanding, who are your major investors, and is one shareholder owning a disproportionately large percentage of the company or not? Because if he does, it might cause some issues down the line if the shareholder decides to leave or his understanding of the company's future is not in alignment with the owners of the company. So for that purpose, it's also always good to know and monitor who are the major shareholders in the company and manage those relationships. Regularly updated cap tables ensure tax and regulatory compliance, which are really important And especially as you get more and more investors, maintaining an accurate cap table, you can assure that you follow all the tax laws and regulations and you don't get in trouble with the IRS, or you are not late with sending a mandatory notification to your shareholders. And also when it comes to audits, it may become an issue later on as a later stage, seed stage company that is acquiring additional financing or investments from institutional investors. As part of their due diligence, they may ask for an audit, a company audit, and a very well-maintained cap table can definitely ensure the audit's accuracy, and it makes it much more transparent and easier to navigate throughout the auditing process.
So two questions on that. One, you talked about IRS and notifications and the compliance notifications. Are there one or two of those big things or use cases for the tax or regulatory side that pop into mind that virtually every startup will face?
Well, you also always have to send notifications to your shareholders about how much shares and at what value they own in order for them to be able to file their tax returns. And also, it was important, for example, during the COVID years when certain loans were issued to startup companies, it was really important for the federal government to understand their financial background and projections. And for that reason, it was also very important to maintain the cap tables.
Got it. That example was very telling, where maybe an issuance of stock, especially the employees in the founding team, is not properly recorded or not recorded at all. So omission is clearly a big mistake that I'm sure you see among startups with the cap table. Are there other types of big mistakes, serious mistakes that you see founders making? And what are those mistakes? What are the ramifications? Why does this happen?
So the number one mistake I see is not updating the cap table on a regular basis. And people, investors, put in more money, or they change their location, their contact information changes. And we keep forgetting it's extremely important to maintain the investors' contact information, because as shareholders, they have to be notified about certain major decisions that are happening in the company's life. Another example from maybe 2-3 years ago, it happened to one of our portfolio companies. They ended up raising money through an online crowdfunding platform. And the crowdfunding platform, when the investment closed, did provide our portfolio company the names of the investors who put in money through the platform, but they did not provide the actual email addresses. And at the time of the transaction, the CEO of the company didn't really care about it. He knew the names and he populated the cap table with the name of the new investors, but there were no emails attached, no contact information attached to their names. And whoops, 6 months later, we had another fundraising, and the existing shareholders had to be notified that there is an additional, bridge being opened, and they are invited to participate. Except we couldn't send out the notifications. We couldn't find these investors. It took us 3 weeks to get the contact information, phone numbers, and email addresses from these investors so they can be notified. And that held back the whole entire fundraising and closing by 3, almost 4 weeks.
Wow, that's an interesting story. So, okay, so I get that this is important. I'm a founder. It all feels really intimidating. I know I've got to start from day one. Where do I start? What do I need to do? How do I go about doing this?
You can start in a very simple Excel or Google Sheets, and you just create a table. The key important elements there are all the investor informations are critical, such as the name, number of shares, and the percentage of ownership held. Type of securities held by each investor, such as preferred or common stock. Then the second one is also very important, the founder information as the owner of the company, a majority owner of the company. The same information, the name of the founder and the number of shares they hold needs to be included. Then very important is the stock value. It includes the price paid for each share of stock, as well as the current value of the stock. It's really important because 2-3 years down the line, if you don't record it at the day of purchase or issuance of the stock, 2-3 years later, you will not remember what was the actual purchase price versus what is the current price of stock. Additional elements that are also important, you don't need to overcomplicate it, but the more information you have, the better. The date of the stock issuance is important. Any restrictions or limitations on the sale of shares Different shares have different terms attached to them, and keeping track of those different terms can be also very, very important.
So that's a pretty comprehensive list. So first off, as a first-time founder or the first early-stage founder, the first thing I'm going to do probably is to raise on a convertible note or a SAFE. How do those types of instruments show up on the cap table? And when I have a SAFE or convertible note, how should I be thinking about the percentage of ownership or the number of shares?
Yeah, so that goes into valuations a little bit, because the higher the valuation, the more shares as a founder you can retain, versus the lower valuation, the less shares as the founder you will retain. But just like I said, ultimately, once you are beyond just raising money from your friends and family and people you know from college, but you actually are reaching out to angel investors, whether through an angel fund or a network, this would be the time for you to switch from just a regular spreadsheet on Excel or Google Sheets. It's really important at this time, or perhaps even sooner, for you to acquire a management software such as Carta or CapShare or ShareWorks. The most prevalent is Carta, and that's what we use. That's what I'm familiar with. The date of issuance of the stock, all the information is automatically included, and all you have to do is just fill in the numbers. And if you don't feel comfortable with that, your CFO can do that, but also your lawyer actually can be very helpful in filling out and helping you creating the cap table. The common mistakes when it comes to the cap tables, again, is neglecting to update it, inaccurately recording the stock value, the price of the stock, missing shareholder information, not considering vesting schedule, overly allocating too much equity to investors can also be a problem. And also failing to change documents, because once you record, for example, an issuance of a convertible debt instrument, that convertible debt will have a maturity date of, 12 to 36 months. And that will convert to actual equity and shares. And if you do not record it at the correct time, it's going to have an impact on your value on the shares. So it's really important to always maintain an updated cap table. And every time there is a qualified financing or another secondary financial round, you need to make sure that the cap table is always updated with all the information.
Got it. So let's say I'm a founder doing this for the first time. I take all your points on how important this is. I get Carter, I have the lawyers, whatever the case might be. First of all, how do I get up to speed? How much do I need to know, even if I have qualified legal and financial counsel on, these are things that are impacting my outcomes at the end of the day. How do I get up to speed, and how much is enough for me to know about all these technical terms that you just laid out?
So as a first-time founder, you don't need to know all the conversions and what different rights mean in the long term, what stock has what provisions attached to them. What is, however, important to you is to really understand how the distribution of shares actually happen in each financial round. It's very important for you to understand that the higher the valuation of the company, the smaller equity shares you need to give up. The lower the valuation as a founder, you're more likely going to give up a larger piece of your company. But what is also important for you to make sure that you educate yourself ahead of time. If you are only raising a pre-seed round of $50,000 from family members, this is not as important as in later stages when you are getting ready to actually go out to institutional investors and angels and angel funds and networks. You should know how a cap table is structured. There are multiple ways to get that information from. I would highly recommend checking out the Angel Capital Association's Angel University classes, online webinars, because they go through in depth into cap table discussions, into valuations, into how to read the term sheet. So that can be a really, really important source. Secondly, I also would look around in your community. Who are the angels? Who are the funders? Who are the different networks? And more often than not, these organizations, including accelerator programs, do have webinars, lunch and learns with lawyers and investors about specific themes and topics. And I would definitely start attending those and learn as much as I can. But the first source for me would be the ACA university courses.
Got it. I like the on-demand resources from the ACA that you mentioned, because I can do it on my own time. It's probably more time efficient than as much as I would like to attend all the seminars and we're outside, there's a trade-off in terms of how much time I devote to it, and I have only X number of hours a day. So that's very well taken. So we talked about cap tables, and then you mentioned this point around valuation, right? That's another big, huge sticking point for founders, especially if I don't have access to PitchBook or other aggregated sources of data for me to peg correctly what I should walk in with valuation. So can you just talk about just how different kinds of investors, so for example, VCs versus angels, might approach valuation, and whether valuation is even important if I'm raising a safe or a convertible note?
Yeah. So angel investors tend to be more flexible and rely more on qualitative factors like the founder's team and vision when evaluating early stage companies. While VCs use a more structured approach, they heavily rely on market analysis, potential exit strategies, and they might also have a targeted return on investment to determine valuation. And VCs often, not always, but often lead to higher valuation for the same stage company compared to angels, but it also depends on regions. And again, this is my experience, and these trends do apply in the Southeast, but there might be different factors playing into valuation discussions in different parts of the region in the country. So you need to really know whom you are talking to. What are your angels' preferences? What do the VCs look for? But overall, if I can overgeneralize it, really the valuation approaches for angels is often to prioritize the entrepreneur's passion, market potential, how good is the team over concrete financial metrics. And this can lead to evaluation based more on potential than current revenue. Angels have a tendency to look into the future and what is the great future potential versus VCs look at the numbers today. What are your sales and revenues, and how does the company financially looking today? Angels are more looking into the future. Angels also, depending whether they are a network, an individual angel, or a fund, due to investing their own money, angels may conduct less extensive due diligence compared to VCs, which can result in quicker decision-making process and potentially a more flexible valuation approach. Having said that, now angel networks are creating their own venture funds, and the funds, for example, in our case at the launch place, we have full-time professionals and we do a very extensive due diligence. So I wouldn't always say that the due diligence process is shorter for angels than for VCs, but overall, it's probably true. We also use different methods. For example, our fund uses a scorecard method. As angel investors, we use the scorecard to evaluate the startups, assigning points based on various factors. Like we have a team factor, the market size, technology, competitive landscape, which can help really to determine the valuation based on a holistic level, rather than just looking at the current financials and the current revenues of the company. VCs, on the other hand, are more likely to use the venture capital method. They typically have a predetermined expected return on their investment, and they aim to achieve that. And then they just calculate backwards from that targeted ROI to come up with an expected exit valuation for them. Also, when you are thinking about valuations and how they impact the future of the company, taking money from angels versus VCs can affect your evaluation, but they can also often affect the control and influence the VCs may have versus the angels. VCs often seek more control over the company by taking board seats and actively influencing strategic decisions, which can impact their valuation expectations. Angel investors may more be hands-off, maybe observers on the board, and provide more mentorship and connections, therefore potentially perhaps settling for a lower valuation.
So, you just laid out a really comprehensive overview of how the investor landscape might look at valuation. So imagine I'm a first-time founder. I'm walking in, maybe I have a STEM startup that I'm going out to fundraise for the first time. Typically, I don't have access to sources like PitchBook, and here information is power, right? So I've talked to a lot of founders who actually are very nervous about, I don't even know where to start the valuation. I've talked to other founders who have come up with like ridiculous, like 37x revenue at first, like this guy, $37 million valuation for a pre-seed or seed, which I was like, okay. So given that you're walking in with this information asymmetry working against you, right? You don't know a lot and you don't know where to start. So how would I equip myself as a founder for a good valuation discussion so that I don't hand over the shop, nor do I walk in sounding like I'm completely out of touch with market reality? Like, what's a practical way for me to do that doesn't take me 6 months to just get to a valuation number?
Yes. So if you are very early, like pre-seed, and this is really your first fundraising, I would strongly recommend to start talking to investors even before you go and ask them money. And that's why the networking piece that I referred to before is pretty important, because you can meet potential investors you will be targeting 6 months from now when you are ready to raise money. You can meet these investors at pitch competitions or when accelerator cohorts are having their demo days. All of us are always there. And I would just approach a person, a fund or an angel fund operator, and say, yeah, I'm planning on fundraising and I'm planning on approaching you in the future or applying through your website. But I really am struggling with valuation. Would you mind talking to me? I would say 9 out of the 10 times every investor would sit down and help you, because for us, it's also important to establish the relationships early. So by the time the company comes and seeks funding from us, we have a much better understanding about the CEO, about the company, about the valuation. So don't be shy to ask investors to help you establish a valuation that can be accepted by both sides. You need to analyze your company's financials and you need to be fully aware of all the details of your financial statements, whether it's COGS or not, because that's going to be a key element of establishing your valuation number. Understand the market trends. If you have a great technology, but the market is kind of in a turmoil, that is going to demand that you lower your expectations when it comes to valuations, right? To me, what's also very helpful when you are a first-time founder, and especially when this is your first time raising money, is researching comparable companies. And I do understand that as a first-time founder, you might not have access to PitchBook, but there are other university sources in your area, MBA courses, that can actually help you researching these comparables. And now also online with AI, you can really do a thorough research and understand what are the comparable companies to you, not just, however, nationally, but also in your geography. And again, ask investors whom you're going to target, what are the companies you have been recently investing in, at what valuation, and they will provide the information for you. I also would like to emphasize that for a pre-seed and seed company, a very early stage company, what's also important is, although you might not have years of cash flow information and financial information, but you need to know your market. You need to research your market. You need to know your market trends and focus on the potential market penetration numbers that you believe you can achieve in a short and long term. You also need to be able to emphasize the strength of your team that you have put together and how it can affect valuations. Maybe you have somebody on your team that this is their second rodeo and they have been a member of a company that exited recently, so they have gone through that process. Or you have a team of extremely talented individuals that have created an IP portfolio that really stands out to me as an investor. So you really need to focus on the story of the future if you don't have current numbers yet, and your market penetration numbers, and also focusing on the trends of the market that you are in.
So if I try to kind of play back what I heard and synthesize, right? The first piece is, it feels like you need to get a good sense of like, what is the starting point? Like, what's a good starting point? And for that, it's around talking to investors who might be investing in your area, doing the AI assisted searches. One question on that is, why will an investor tell you what valuation they put on a company that they just invested in? I mean, that's private market information. And potentially there's a conflict of interest. Like, why would I come and tell you, like, I mean, I'm just being a little skeptical.
And I wouldn't tell you that I invested in Eva Doss's company and the valuation was $6 million. I would not tell that. But I would tell you that during the last 12 months, we have invested in 8 companies, and the average valuation for those 8 companies was $6 million. I'm making it up. Okay. out of those 8 companies, 3 are more comparable to you than the others. And the multiple that we used for calculating the valuations for those 3 companies, the industry multiple was 3.5. So I'm not going to disclose confidential information about specific companies in my portfolio, but I will be able to tell you where the market is and what we are seeing, not just in terms of our new investments, but also in terms of our bridge financing of our existing portfolio. So we are very aware of the market trends and the market conditions. We are very aware of the comparables, and we are happy to share that information with you on average. But no, we will not be disclosing sensitive private information with names and stock prices.
Got it. So do you think that's uniform across A, angels, and B, VCs? Like, somehow I'm very skeptical that it's going to be uniform, that people are going to be so helpful and say, to the point of that you just mentioned, like to that extent.
So I can only speak to my angel fund and network experience. Us as angels, we do work together very well and co-invest in multiple companies. We are members of multiple syndication networks through the Angel Capital Association, but also in our region. And it is in our best interest for our angel networks and funds to work together, because none of us are large enough to be able to carry and completely fund a Series seed fundraising. We are not going to write a $2 million check and carry the whole entire fundraise. So as funds and networks and angel investors, we have to work together. And believe it or not, it's a very collegial, cooperative, helping each other market, at least in North Carolina, Virginia, in the Southeast. That has always been my experience. And we also want to make sure that by helping the founder to get to a realistic valuation number, we also are going to have an easier time when we come to an actual negotiation on the terms and the valuations, because the expectations are set both by the founder and by us. So it's a more of a comprehensive approach in terms of finding a balance between what the founder wants and what the investor wants, and finding that middle ground. In order to find that balance and come to a mutually agreeable valuation number, we need to help the founders, and we do. On the VC side, it might not be the same situation, but when it comes to angel investors, we work together, we share information, and we help founders to be able to close their fundraising as soon as possible by collaborating and sharing information with them.
Got it. So point number 1, talk to investors, get a good lay of the land. Thank you for explaining that. The other piece I picked up from your earlier explanation was you need to have some sense of numbers in terms of what your potential is, what your market penetration is. You talked about multiples. How can a founder get a realistic sense of what that market penetration is? I mean, we've all seen the big TAM, SAM, SOM numbers, that they just throw around without any background. What will convince you as an investor, if I come in as a founder and say, these are my market penetration numbers, and therefore my valuation, I can justify my valuation that I'm putting forth of X?
Yeah, so I immediately will ask you about your customer discovery journey. How many interviews have you conducted? How many surveys have you conducted? Have you gone through 100 interviews with your potential target market customers? How many institutional target market customers have you spoken to, and what was their feedback? So I really need to know that the numbers you are presenting about your potential for growth and market penetration is supported by your surveying and researching your target market customers. And even then, we're not going to take it at the face value, because during our own due diligence process, we will be talking to your potential customers, and also through our networks find comparables, whether it's a hospital system, whether it's an educational system, whether it's a big manufacturing organization. We will be testing your numbers during our market discovery, during our due diligence process. But having the numbers and being able to prove that you have done your homework and you have spoken to 100 customers in the last 2 months, and this is the feedback you have received, is very, very important when an angel is making an investment decision.
Before we dive back into our conversation, I want to tell you about Seed to Success. Seed to Success is our community letter with our proprietary insights on startup financial storytelling, tips, new episodes, and much more. If you find these discussions helpful in your entrepreneurial journey, use the link in the description to subscribe to Seed to Success today and get all of these and much more straight to your inbox every week. Now, back to our conversation. Got it. So the picture that I'm seeing coming up is like there's nothing that's isolated on its own. Valuation is not just some number that's hanging out there by itself. Yes, there's a market input into it in terms of where you are relative to all other startups and your peer group, but your own financial story, so to speak, is an integral part of why you're able to support that valuation. So in other words, you're not doing customer discovery on its own and then evaluation on its own. They all kind of have to speak to the same storyline and they all have to hang together. My last question on that is, let's say I do all the research. I've given you the summary of 100 customer interviews I've done. I give you a projection of here's where my market growth is going to be. How then do you translate that into the valuation result?
So the valuation result, again, comparables. We will look at other comparables and also reach out to other investors, co-investors, and syndication partners and ask them, like, this is a SaaS software, enterprise software company targeting higher educational institutions. Have you guys had experience with this? And what were the actual terms under which you invested? So at that point, we are going to be making our own due diligence amongst our investment partners. And also looking at comparables, we do have access to PitchBook and other industry-generated sources, so we can actually look at the actual numbers that the market is giving us and then come up with a valuation. We're also going to look at the company, how it relates in our overall portfolio of invested companies. What is our portfolio structure? And the last 12, 18 months, what were the deals that we closed and what were the companies we invested in at what valuation points? So the valuation discussion is not a science, it's an art when it comes to angel investing. With VCs, it's much more strict because of the financial focus and the actual number they need to get at when it comes to ROI. But with angel investors, it's a discussion and there are financial components to it and there is an actual number that we need to come to, but it's definitely more of an art form than science and it's part of a negotiation process.
Got it. So the one thing is there's this tendency on the part of founders, or at least the inclination is I want to get as high a valuation number as possible for obvious reasons, right? Because I want to minimize my dilution. I want to get a bigger check, blah, blah, blah. Too low valuation isn't good. But is there a point at which too high valuation isn't good? And if so, what are the negatives from having a valuation that's too high?
So when the valuation is too high, first and foremost, you need to be very careful because if you need to raise subsequent funds and you have another round 12 months from now, fundraising, you might not be able to demand a higher valuation from your current valuation if the current valuation is already set too high. You might end up having to have a downward scenario where you have to cut the valuation. And trust me, nobody's going to be happy about that because everybody's going to get diluted, not just the founder, but the investors in the current round as well. And secondly, it also can create a reputation, a market reputation amongst investors. And again, as an industry, we work together, we co-invest together, we look at almost the same companies together, and we do talk amongst each other. And if you come across as a very stubborn individual who cannot find a common ground, a balance, then we're just simply not going to invest. And later on, when you come back to us for another fundraising, that reputation will be there. We have had a company that actually it happened to us multiple times, that they were raising a seed round and the valuation was very high. I don't remember exactly the numbers, but I know it was very multiple, 3 times as high as we were used to seeing in the marketplace. And we told them that, sorry, because of the valuation, we just simply cannot continue in the negotiations. And the response back okay, then we're just going to go to California or somewhere else in another region where they will give us the valuation what we want. And I said, well, great, good luck. I hope it works out for you. And in one case, 6 months later, in another case, 12 months later, they came back to us and said, well, we were not really lucky raising that amount at the valuation level we demanded because even outside of the region, investors refused to take that valuation, what we wanted from you. So would you reconsider now coming back to the table and renegotiate? So we renegotiated and we ended up investing in the company, but they lost in one case 6 months of fundraising, in the other case 12 months of fundraising because they refused to lower their valuations and they were not able to secure funding. So you need to be looking at what are the pros and cons. And I completely understand the lower the valuation, the lower the shares and the controls of the founder. But ultimately, very high valuations can also negatively impact the founder and ultimately the investors in the long term.
Got it. And, this is one thing that I think I see founders missing a lot of the time that investors have a much stronger grasp, which is it's not just about the valuation. Your deal has a lot more aspects to it than just the valuation. So the question to you is, as an investor, is the valuation a sticking point by itself, or are you willing to give on the valuation so that how are you looking at valuation in the totality of the deal terms?
Valuation is one of the key elements of agreeing to the deal. It's not the only element, but I would say it's definitely in the top 3 elements. Even if everything else fits, even if we agreed on the terms and whether it's going to be an equity round, whether it's going to be a convertible note issuance, if we agreed on the proceeds of using the funds, if we agreed on whether we're going to get board seats or not, ultimately, if the valuation is too high, we will not do the deal. But if the valuation is accepted and mutually agreed upon, just because the valuation is good and agreed upon, we also may not invest because the valuation is just one of the key elements in the structure of the deal. Does it make sense?
Total sense. So given how important valuation is, right? And one of the things I've talked to multiple investors, some legal advisors as well. And one trend that has kind of bubbled up is when women founders go to the table to negotiate, right? There's a kind of a triple whammy effect where they get a smaller check, lower equity, lower valuation kind of deal. So what advice would you give to women founders in STEM to get the best, not to say the highest valuation, but I'll say the best outcome on valuation for their own startups, given that they may be battling these kinds of barriers?
Yeah, so women founders will face the same obstacles potentially when it comes to valuation negotiations, but they even say will be facing more obstacles because simply there is a gender bias and there are legal barriers and lack of access to resources for women more so than for men. And the gender bias is there. There are very few angel investors who are running venture funds or angel group operators, although lately it has been changing and more female investors started their own funds or are managing their own funds or becoming network operators. But there is still an overall gender gap between how many female investors are investing and also how many female founders actually are seeking investments from investors. In order to overcome these barriers, my first advice to every female founder is really be strategic and intuitive in selecting your investors. Just like us investors select the companies we invest in, I think the funders also need to be very cognizant of which investors they would like to accept money from. And I would strongly recommend for female investors to seek out the networks that include female investors run by female fund managers or network operators. And there are many funds and networks now. The whole purpose in life is to only invest in female founders. There is a good list on the ACA website, but also Sylvia Ma from Stella Ventures from San Diego created a list on LinkedIn that's very up to date about all the female investors who fund female funded companies. That would be definitely my number one choice for women founders to reach out to women investors. Secondly, I would also attend, if you can, both in person or online, events, pitch competitions, meet and greets with female investors at different events hosted by ACA. Every fall, we have the Women Investor Forum in Boston, for example, is a good event to attend, but also inside your own region, seek out events and networking opportunities when you can meet female funders and female investors. because those networking opportunities will lead to connections. And sometimes it's very good to even not just seek out female investors, but also female founders, because those female founders can introduce you to investors who have helped them fund their own companies.
So your points are very well taken. And I think the resources that you mentioned are awesome. We'll make sure we include links to them. Can I challenge you on that a little bit on 2 points? The first is the unspoken assumption is that you'll get a better deal with a female investor. My pushback to that is, how do I as a woman founder get a better valuation outcome regardless of, even if I'm talking to male founders? I mean, just pure absolute terms, there are more male investors in the early stage startup system than, or at least more dollars, let me put it that way. There are more investment dollars that are controlled by male investors than they're controlled by female investors. So it's, as a woman founder, I'd want to make sure I get the best outcome, even if I'm talking to male.
I did not make that assumption that just because you're going to talk to female investors, you're going to get a better outcome.
Point taken.
Talking to female investors might actually get a meeting for you and get invited to pitch, versus if you're focusing on investors or funds that are not focused on female investors, you might just get lost in the many, many different applications. So my point is that even getting a pitch or getting a consideration, your chances might be higher by first approaching funds and investors, female investors whose purpose in life is to invest in female funded companies.
Got it. So the message, sorry, and my bad, thank you for correcting me on that. So what I think I heard you say is, yes, the valuation comes, but make sure that you actually get in the door to get that discussion.
Correct.
Is that the main point you made?
Yes.
Okay.
Yes.
Thank you. Thanks for clarifying that. My second point on that is there was a research study that came out recently that showed that women investors investing in women founders in the first round actually turns out to be unfavorable for future financing for women founders, because the assumption is you were invested in because of homophily, meaning that, they invested in you because you're a woman, as opposed to because you have a, fundable startup. So I'm just curious what your thoughts are. I mean, I know this is getting a little away from valuation, but since we're talking about that, I just want to get your thoughts on that.
Well, that's unfair, but life is unfair. I mean, we know that there is a gender bias, and this is part of the gender bias. Having said that, if the company as a female founder can prove that, yes, my first investment I received from a female investor, it wasn't because I was a female, it's because I had a strong business model, and look what I did with that funding, how I used it, and what are my tractions to this day. So for women, you also need to be able to tell the story much more, perhaps aggressively. I don't like to use that word, but you need to persuade the investors that you are not just getting the female investor funds because you are a female yourself, but because you can prove to them that you meet your milestones, that your financial management skills are very better. You can go further with less money compared to your male counterparts, which is a case very often, actually. And you need to point out these achievements that you have achieved since your first fundraising to persuade that the second round, you do have very viable fundamentals, whether it's the financial results, whether it's your market penetration, whether it's the IP structure that you have created, that you deserve the higher valuation, and the women didn't invest in you just because you are a female.
Got it. So kind of the main takeaway for me, and that is a very helpful explanation, is you take the doors that are open to you, and then you continue to aggressively build the fundamentals, the financial story, to make sure that your story is standing on its own legs and that the numbers are speaking for you.
Yes.
To counter any potential negative backlash that you took any money from a female investor. With that, I want to talk about funding instruments, everybody's not favorite topic. I just had Liz Siggety on and we talked about convertible notes. In this conversation, I want to do a deep dive into safes because there's so much conversation around safes. So there's a lot of pros and cons. There are many pro-safe people and many anti-safe people. Can you just give us an overview of maybe some of the misconceptions around safe, both on the positive and negative side?
When it comes to safes, I am a little bit biased because our fund does not invest in safes. And again, we are in the Southeast, and that's just a prevalent theory around here. We do not prefer safes, although safes, which by the way stands for Simple Agreement for Future Equity, started in California. And since its beginnings, originally SAFE was used to really raise pre-seed money in a very early stages, almost ideation stages, and maybe $100,000 to $200,000. Now, lately, what I have been seeing is a lot of companies are putting forward SAFEs for multi-million-dollar fundraisings. And actually, that just happened to me last week. And I said, no, at this point in time, you have been operating the company for 4 years, you can do a price round. But SAFEs are becoming more and more prevalent. And some companies prefer that, some funds prefer that, individual investors prefer that because they say it's simpler. The convertible debt instrument is registered as a debt on your cap table versus SAFE is not, but the SAFE will become important when the qualified financing happens and the SAFE converts into actual common or preferred shares. I don't personally like SAFEs because they avoid very important investor rights for the future. Many companies who come to us with SAFEs do not necessarily understand that. I believe that SAFEs can be used in situations where the company only needs a few $1,000s and in regions where there is an overflow of investment dollars. If you are in a region where investors are more scarce and the investment activity is not as high as in Silicon Valley or New York, then you potentially need to be considerate of the investors' willingness to even consider SAFEs. I think convertible debt and equity rounds are much more acceptable by investors, even though nationally the usage of SAFEs is growing. They are considered simpler and faster to set up and often do not include valuation caps whatsoever. And that might be a good thing for the founder, but not necessarily for the investor. Sometimes they do include some investor protections, but many times they do not. And I just came across a couple months ago a situation where the company was raising a SAFE and we were the first institutional investor that they approached. And I was very open with them. And I said, I love the business model. I love what you are proposing. We would love to invest. However, we don't invest in SAFEs. We would like to have additional protections because we also don't just write one single check. Our tendency is to stay with the company for multiple rounds of financing. And we don't just invest $50,000, but we can go up to $750,000 to $1 million over a period of years. So as institutional investors, you might want to consider negotiating with us because we can be helpful to you, not just today during this fundraising, but all the way through potentially exit. And the founder was very sensitive to my request and we started negotiating. Ultimately, what ended up happening, I requested him to give us a side letter, and the side letter had to include all the investor protections and provisions that we normally would have in a convertible debt instrument. It secured our redemption rights, pro rata rights. It gave us additional observation rights, board observation seats. So all the terms that we would negotiate in a convertible note, we ended up negotiating in a side letter. And then the other investors also wanted a side letter. So by the time the founder actually closed the round on a SAFE, pretty much each and every investor had a separate side letter. It took him at least 3 months longer to close the round because everybody wanted the extra protections. And ultimately, all of this could have been totally resolved by just doing a convertible debt instrument, which ACA has on its website, a very simple convertible note document, and just use that. So to me, from the investor point of view, SAFEs are not as good as convertible debts. And many institutional investors whose purpose in life is to really stay with the company until exit, more often than not, they do not accept SAFEs.
So,
did I say too much?
No, I love the way that you really explained it because many founders don't understand it, they don't get it, and you really made it, you made it real. So I appreciate that. So is it a question, you yourself commented that SAFEs are becoming more popular.
Yes.
What's driving that? Is it just a question of too much money chasing too few deals because the market isn't there?
Yeah, so I think it's a combination because, again, in Silicon Valley in California, SAFEs were invented there and SAFEs have been approved and accepted for a much longer period of time than in the other parts of the country. But also, SAFE is not the same SAFE today as SAFE was when it was introduced. So the prevalence or the increase in the usage of SAFEs might be also contributed to the fact that, yes, even investors who sign SAFEs, technically it's still called a SAFE, but if they have an attached side letter, which side letters are almost like a norm now to SAFEs, that what I'm seeing in our region. So it's still called a SAFE, but technically it might as well be called a convertible debt because investors negotiate those side letters. So I don't know if the increase of the number of SAFEs is just purely contributable to the fact that there is more angel investors who are willing to accept it, or is it more a causation that, yes, it's a SAFE, but investors are willing to and are more successful to negotiate the investor rights that they are looking for?
Got it. And when you said that, with the side letter and all the protections, it becomes almost equivalent to a convertible note. I'm assuming it still is
Absolutely.
missing the interest rate piece,
Yeah.
right? There is no interest rate.
Yeah. There is
It
no
has
interest.
everything else minus.
A minus interest rate and a valuation cap.
No.
Although I have seen that too. I have seen SAFEs with a valuation cap and an interest rate included in the SAFE. It just didn't have investor protections. So there are different variations of SAFEs, and you need to be very careful reading all the terms and conditions in them because it's different. Every single SAFE I've read or seen is different.
So from the point of view of a founder, what I'm hearing you say, and thank you for being upfront about your bias. What I'm hearing you say is, yes, there's a perception that SAFEs are quote unquote simpler and cheaper, but in the absence of investors chasing you down to give you money on any terms, including, doing a SAFE, you might be better off considering whether a convertible note, for example, if not a price round, would be just as good and maybe even more effective for you, purely from a selfish point of view that you want to get it done sooner, you want the money faster, and you want to keep moving ahead and keep your investors happy. Is that a fair conclusion?
Yes. And also there are other things that SAFEs are problematic down the line, but one of them is also future fundraising. If you are raising on a SAFE, I don't know, a $500,000 round, and then half a year later, 6 months later, you go out and raise a $2 million seed round on a convertible debt instrument or equity round, but most likely by now it's convertible debt. The investors who are coming in potentially on the second round of financing will not agree for the SAFE investors to have better investor rights if they put in less money. So eventually you will have to go back in some occasions to your investors who put in their money under the SAFEs and make them agree to the terms of the convertible note that came later, which is time and money and negotiations.
Got it.
A lot of investors will not consider investing in your company if everybody on the cap table is safe and the safe investors are not willing to agree to have the same terms as the investors coming in the latest round.
Got it. So there's one aspect which we didn't talk about from a SAFE standpoint, which is what is the implication of SAFEs? How does that flow into your cap table, and how should you be accounting for SAFEs in your cap table if you issued them?
So the SAFE actually, again, just like you have the different sections about what type of stock was issued, you just actually count them as a SAFE. You say it's a SAFE agreement, so you're not going to have a valuation cap, and then you need to register the insurance of the SAFE, the number of stocks, and then also what are the terms of either the conversion or what are the liquidation preferences on the SAFE. And at the time of the conversion, which is most likely a qualified financing, then the SAFEs either convert to common or to preferred. So there is not a big difference in recording them between the convertible note and the SAFE. Convertible notes just are going to have more terms related to protecting investor rights.
Got it. So with that said, we've talked a lot about cap tables, we've talked about valuation, we've talked about funding instruments. Taking all of this and taking a big step back, if I'm a first-time founder, I'm now contemplating doing my first outside round and potentially the first of many, multiple outside rounds. What are the top 3 actionable takeaways you would give me to start working on tomorrow so that I'm in the best possible shape to make my startup a success and have good financial outcomes?
So first and foremost, I would do my homework of understanding the investor landscape in your region. Know your VCs, know your angels, know your individual angels. Know who is out there in the marketplace, because when you start fundraising and this is your first time fundraising, the likelihood of you securing investment from a local regional partner is much higher than if you go outside of the region. Angels still like to invest in regional companies that they can visit or attend board meetings. So really understand who is in your market, who are the angel funds, angel networks, and the VCs, and get introduced to them as soon as possible, even prior of you actually officially announcing your fundraising. Start attending their events, start reaching out to them. Many of us judge at different business pitch competitions, attend different events, make those connections early on, and understand what drives them, what are the motivational factors for each VC, angel fund, or angel network. Understanding investor motivations will really help you navigate the whole negotiation process, because then you will know how to prepare to negotiate with an angel network or versus an angel fund or a VC. Individual angels have different motivational values and different motivational outcomes and expectations than VCs do. VCs are about return on investment, and they're investing other people's monies, versus angels are investing their own money. And in many cases, angels, yes, they want their money back. Don't take me wrong. This is not their charitable giving contribution. They do want to make money on the investment, but they also want to give back to the community. In many instances, they were founders at one point in time and they exited and they had a healthy exit, and now they are investors and they want to help other companies coming behind them. And they're also very motivated by making sure that the founders get access to not just the dollars, but also to educational coaching and mentoring activities. So really do understand who is in your marketplace, what is their motivation. And thirdly, when it comes to valuations, really do your homework and try to understand as much as possible about comparative valuations, comparative companies in your region or nationally. So even if you do not know an exact valuation number, you have an understanding that you are at least in the ballpark with your comparatives, and you are not outpricing yourself from the market just because you are demanding a very high valuation. I think those would be the 3 points.
Perfect. Thank you very much. So we've covered a lot of things, and you've been very, very clear and interesting the way you laid out a lot of these things. On these topics, is there anything that you wish I'd asked you, but I didn't?
Maybe how to engage with investors, but I have talked about that throughout this podcast. I think many times founders are afraid to engage with investors early on. And don't be afraid, just ask, introduce yourself, because whilst you are looking for your future investors in your company, we are also looking for qualitative deal flow. And we like to know the funders early on, even before they potentially start fundraising, and establishing those relationships are really important. So don't be afraid to reach out to investors and approach them, either at events, webinars, wherever you come across with them. Start a conversation, because it's going to be very beneficial to you once you start fundraising.
So I'll ask you just one question on that before we close, which is, we know many angels in common. And when I talk to them, every one of them says, I get all these unsolicited DMs on LinkedIn that just like, hey, give me money, right? And clearly you don't want to be engaged with that way. What is the right way that will make you most willing to respond and say, hey, that's interesting. Yeah, sure, let's talk.
Always the number one best way to approach an investor is through a warm introduction. So if another investor wants to introduce you to me and we have a good relations, fantastic. If your accountant, the accounting firm you are using, happens to know an angel investor and the accountant introduces you, that's definitely going to get attention. No direct messaging. I don't know how many pings I get on LinkedIn. I simply don't have time to read them all. And I'm not saying that they are not good companies, but I just simply do not have time to read them all. But definitely warm introductions are the number one. Second, look out for the websites of these angel funds and networks. there are actual application formats there and you can fill them out. And if you go through the actual step and applying to our fund or to another angel network, that's automatically guarantees that I'm going to read your pitch and I'm going to read your application. So that's really important. And then again, attending events, listening to their seminars, finding out where they're going to be, where they are judging, what events do they attend, and try to make an appearance and try to talk to them and approach them in person on the spot where they are judging or where they are networking.
And what would I ask you as a first? So if I don't have the accountants outreach, if I don't have all these and I'm only seeing you at a pitch event because I don't have the networks, right? What would be most effective if I saw you at a pitch competition, you're judging? And then what do I say to you to say, Eva, what do I say?
Yes, Eva, thank you so much for coming today. I'm really interested in learning more about your fund. I'm starting a company and I'm very, very early on. And I know you guys also have a pre-seed fund and do have a lot of educational mentoring coaching services. How can I learn about that? I'm there to judge, not because I have nothing else to do in my life. I'm there to judge because I'm also looking for deal flow for our funds, right? And sometimes those are the pitching companies we are judging, but most often than not, during the reception time is when I found founders and the founders found me. And once I can put a face with the business card, I will say, yep, you want to learn more? Go on our website, look at the different services we are providing. And if you like any of them, please reach out to me. Here is my email. And then once I give the email and an invitation to follow up with me, you need to follow up with me, because if I don't hear from you for 6 months and 6 months later, you're like, hey, remember me in January? We were at this event. Probably won't remember, or by that time we have moved on to something else. But yeah, don't be afraid. When people approach me at these events, I always am very happy to talk to them, because we have a common goal here. Like, we want to find good investable companies, and the founders want to have investors who can invest in them, want to meet investors who can invest in them.
Fantastic. This has been an amazing conversation, Eva. Thank you so much for taking the time. And we really appreciate it. I know that listeners will really benefit a lot from this. So thank you very much for taking the time.
Thank you so much, Shubha. I really appreciate it. Thank you.
And that's a wrap for today. Thank you for tuning in. If you find these conversations helpful in your own journey, please subscribe to Seed to Success, our weekly community letter with tips, insights, resources, and more. If you have any other questions relating to startup finance or financial storytelling, send them over to me at chakras@achieve.co. That's chakras@achiiv.co. We'll see you on the next episode of Invisible Inc. Now, go achieve.